Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Verizon stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Verizon is a telecommunications company and part of the Dow Jones Industrial Average. The company is based in New York City. In 2015, Verizon acquired AOL, and 2 years later, it acquired Yahoo. Verizon's subsidiary, Verizon Wireless, is the second largest wireless communications service provider in the US, with 153 million mobile customers. Let's get started with the model. This is a large cap company, 243 billion market cap. They're trading at $59 a share, and they have 4.1 billion shares outstanding. Let's look at the financials. The way you value a company is you forecast the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company has growing free cash flow each year from 7.5 billion to 19 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. They had 30 billion of net income in 2017, and that was cut in half in 2018 to 15 billion. Revenue is the sales for the company, and that's pretty steady, 126 billion to 128 billion. This is the company's income statement. The top line is the revenue, below that is the cost of revenue, and then the difference is the gross profit, and that's pretty consistent year to year, from 75 billion to 76 billion. Below that is their operating expenses, and then you have operating income. And that's also been fairly steady, a little lower in the trailing 12 months, but they did have lower revenue in the trailing 12 months when compared to 2019. The company does have a lot of debt, so they have a pretty big interest payment, over $4 billion of interest on their debt. And then they have other income and expenses, and then of course taxes. They had $18 billion of net income, which was a little lower than 2019 of $19 billion. The reason their net income was so high in 2017 was this $10 billion tax credit. The company had $20 billion of taxable income in 2017, yet it got a $10 billion tax credit. Their net income was $10 billion more than their pre-tax income. So this article is from 2018. The article mentions that in the fourth quarter of 2017, the company had a $17 billion gain. This was all due to a new tax law. But these types of things are non-cash items. Even in the article it mentions, for the most part, investors and analysts will look past these paper gains as they don't result in money that companies can spend. This is the company statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see they generated $41 billion in the trailing 12 months, their most ever. And then there's capital expenditures, which are investments in property, plant, and equipment. And this company has a lot of CapEx. When you combine operating cash flow and CapEx, you get your free cash flow. And that was $19 billion in the trailing 12 months, their highest ever. So you can see the company issues a lot of debt. They issued $32 billion in 2017, but they repaid $24 billion. So they increased their debt load $8 billion in 2017. In 2018, they decreased their debt load $4 billion, then a $5 billion decrease in 2019, and then a $2 billion increase in the trailing 12 months. But the company has more than enough cash flow to pay the interest on its debt. The most important part of any business is their operating cash flow. You ideally want to invest in a company that has positive and healthy operating cash flow. And this company definitely does. They had $41 billion in the trailing 12 months. To calculate operating cash flow, you take net income, then you have to add back the non-cash items that were passed through as expenses on the income statement. They had $16 billion depreciation, $1.6 billion of write-offs, and over $4 billion of other non-cash items. They also had a negative $1.5 billion of working capital. In 2017, they had net income of $30 billion, but remember the $14 billion tax credit, that actually improved their net income, but we have to take that away on the statement of cash flows. That's a big reason our operating cash flow is less than their net income in 2017. Let's look at a capital structure. They have $62 billion of equity, $133 billion of debt. So 32% of their capital structure is equity, 68% is debt, and their WACC is 4.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for that $701 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $636 billion. We divide that by 4.1 billion shares. And we get a calculated stock price of $154. They're trading at $59, so they're trading at a 62% discount. It's a really strong buy according to the model. Simply Wall Street is at $115, so they're also saying the stock is undervalued, just not as much as me. So you can see the stock has been up and down over the years, but overall it has been increasing. It looks like it peaked about $62, and it looks like it may have touched around $40 at some points, but it's a pretty tight range. The company raises their dividend little by little each year, from 57 cents up to 63 cents. So they pay a pretty decent dividend yield, 4.2%. That's annual dividend over market cap. Or you can just add up the last 4 dividend payments and then divide that by the stock price. Their payout ratio is 56%. That's annual dividend over net income. And they pay out 54% of their free cash flow. That's annual dividend over free cash flow. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $25,000 today. If you did not reinvest the dividends, you'd have about $22,000 today. The company has a really low beta, 0.4, so the stock is much less volatile than the market. And the stock has gone down 2.5% in the past 52 weeks. The S&P is up about 16% in the same time frame. And the 52-week low is 49 and the high is 62. The stock is trading slightly above its 200-day moving average. And this is a really liquid stock. Over 15 million shares are traded each day. And all the shares outstanding are on float, which means they're available to investors. 2/3 of the shares are held by institutions, and it has a really low short percentage, only 81 basis points. Vanguard is the largest shareholder at 8%, then BlackRock at 7.25%, State Street at 4%, then Capital Research, then Geode Capital. Let's look at the financial ratios. The average PE in the market's 12.1, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 13.3, so they're between the median and average. 13.3 indicates investors are paying $13.30 for $1 of earnings. Price to sales is stock price over sales per share. That's really good at 1.9. Price to book is stock price over book value per share. That's 3.9, which is between the median and average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $63 billion of equity, but negative $68 billion of tangible equity, because they have $129 billion of intangible assets on their balance sheet, $24 billion of goodwill, and $105 billion of other. Other intangibles are patents, trademarks, things like that. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They have a really good ROE at 29%. Current ratio is current assets over current liabilities. They're only at 0.8, so they can only cover 80% of their current liabilities. Their current assets are $2.5 billion of cash, $25 billion of receivables, and $4 billion of prepaid assets. So even though the company generated $19 billion of free cash flow, they may need some more debt to run their business over the next 12 months because they have negative $7.4 billion of working capital and a $10 billion dividend payment, assuming they don't cut their dividend. And their future free cash flow may be lower than $19 billion. The best way to look at ratios to compare them to similar companies, I've done videos on Bell Canada, Rogers, Shaw, at&t, TELUS, T-Mobile, Vonage, and Zoom, all in the same industry as Verizon. And if Verizon has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They're better in all the price multiples. They're not doing so great in current ratio. ROE, they're doing really good. They provide a great return to their equity shareholders. They're higher in debt than the average company, and they're the biggest company in this group. They're a massive company, $243 billion. And they pay a good dividend, a little more than the average. So to summarize, I have them trading at a 62% discount. They have such a good brand. They still seem to be generating tons of cash flow, even during the pandemic. They have such a big market share, it would be difficult for other companies to penetrate that. But as you know, anything can happen. Let me know your thoughts on this company, and who do you think can displace them? Obviously, at&t is a giant as well. But is there a smaller company out there that you think can be bigger than Verizon or at&t one day? So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.